have retail-based trading, and we are based in Kolkata. We believe that knowledge is the most important thing that makes difference in any field. So that's why we are starting this initiative, uh, this kind of webinar. This is the first part. We are going to do several more parts of this webinar, and we request you to visit our website, which is proficientgroup.in, to get your regular updates about market, about trading strategies, psychologies, about all those things. About myself, my name is Shumoy Goswami. I am a senior research analyst with Proficient for past several years, for past 6 years. My domain is technical analysis, statistical analysis, trading psychology, and system design, trading system design. I'm also doing CNT. I'm right now, I have cleared 2 levels of the CNT exams. Right now I am preparing for the 3rd level. So that's about me, and we are now about to start the presentation. The topic of today's presentation is survival strategies for trading. Now, why we think it is important? Because people do not understand the risk. That is the most important thing, understanding the risk. So they take wild risks, and ultimately the result becomes bad for them. So we thought it is very good to start with a basic conception of risk, how to manage risk, and the psychological aspect of trading. After that, in our second part of this presentation, that will take around 2 weeks from now, that will take place, we will also be giving you a particular trading strategy about the overall stock market and specific stocks as well. But before that, we think trading psychology, trading system development, having these conceptions are most important, and these conceptions are not regularly dealt with in other media or in books like that. So these we think are very important. So let's start with today's presentation. Okay, so I'm giving you a few seconds to go through the slides, and then I'm going to start. You see, when I was thinking how to define and managing risk in stocks, I was looking for a proper example, and I came across these things. Every day when we scroll through the newspaper, we come across several news of traffic accidents where several lives are taken away. Why these traffic accidents are occurring so frequently in India? And I got a figure that approximately 400 people die in India due to traffic accidents every day. Every day. This is certainly not acceptable. Why so many accidents? Why so many loss of death in traffic accidents? The traffic rules are very easy, you know. For example, do not drink and drive, do not overspeed, wear helmets or seat belts, keep to your left, etc. So the traffic rules are very simple. But thousands of people are still dying. because they are not appreciating the risk of not following the traffic rules. They are risking their lives by doing so. Uh, why do they do so? Maybe they are driven by some ego. Maybe they have some overconfidence. They may be thinking that the rules are for others, not for me. I'm bigger than the rules. Nothing will happen to me because nothing has happened to me in the past, and so many things. Consequently, some 400 people die every day. Now, imagine a city where there is no traffic rules. You can see the diagram to the left of your screen. This is an absolute chaos. You are free to do whatever you wish to do, and the police is not going to do anything against you because there is no police at all. It's a perfect chaos. It's a perfect chaos out there. Now, my question to you is: would you dare to live in that city? Would you dare to live in a city like that? I hope not. Now let us come to this financial world. The financial world that we are trading is just like a city where there is no rule. There is no police here. Yeah, I am specifying there is no police here. You may say there are polices, like in our Indian context there is SEBI, in US market there is SEC, SEC. But in spite of their presence, the system is absolutely inefficient. So many loopholes are there. You see the newspaper is abundant with so many scams, and recently we are also going through one such big scam. So these things definitely prove, and so many scams have occurred in the past. So these things prove that the policing system is absolutely inefficient, and it is the law, it is the nature of the system that there is inefficiencies out there, and it is because of this inefficiency traders make money. The wealthy people, wealthy, by the term wealthy people I mean institutions, big institutions who have the big power of money, they actually eat alive the undercapitalized poor retail traders. And that is the rule of this financial world. It's a chaos out there. There is no rule of law at all. So we have to trade in this market. We have to survive here. And for that survival, what should we do? To survive in the world of finance, you need to follow rules for yourself. This is where rules are coming to play. Now, there are two sets of rules. First, you have to achieve the proper mental attitude towards risk. What do I mean by that? You have to achieve the proper mental attitude. You have to define risk. You have to manage risk and these things. For this, you have to attain some mental attitude towards risk. In this presentation, we will take care of that. We will be going through this. And second, you have to follow a particular trading system. Now, what is a trading system? A trading system is nothing but a collection of some actionable code of conduct with several what-if situations. What-if situations means if certain things happen, you will react in a certain way. Say, for example, if Nifty rises 100 points, you will buy Nifty or you will sell Nifty. If Nifty falls 200 points, you will do this, you will do that. These are the rules you have to create for yourself. You then have to backtest the rules to see their viability. And the most important thing is the trading rules must be historically verified for their robustness, and it also suits your perception of risk. What do I mean by your perception of risk? Means everybody sees risk in a different way. Suppose you are trading Nifty. Uh, Suppose you buy Nifty and it falls some 10 points. You may say, okay, it has fallen 10 points. This is a lot of money for me. So I will exit and you take your loss at 10 points. Some other person may say 10 points is okay for me. I will give a stop loss of 100 points. So accordingly, his stop loss is that there. So the definition of risk, the perception of risk varies across person to person. So the trading system that you have to define for yourself has to align with your particular definition of risk. You can buy others' trading system, but there is chances that the risk defined in that trading system may not align to your mental attitude towards risk. So in that case, it will be very difficult for you to follow your rules and follow that trading system. So this is the most important thing. Discipline. Discipline is the most important virtue for trading. You see, one who survives in the trading game is the one who appreciates risk and can follow his rules, come what may. When I'm talking about trading systems, they are nothing but a culmination of some rules. If you deviate from your trading system rules, it will be a mistake. Now, what if you do not have any trading rule at all, any trading system at all? In that case, everything you do is a mistake. And your financial ruin is for sure. So that's why discipline is the most important thing. But later on in this presentation, I am going to give you certain ways of approaching the market. I will give you 5 fundamental the ways in which market moves. If you can accept those 5 fundamental beliefs from the core of your heart, then discipline will not become any problem for you. You will be disciplined in your approach towards market. When there is a buying, when there is a buy signal, you will be able to take that buy signal. When there will be a sell signal, you will be able to take that sell signal. If there is a stop loss, you will be able to take that loss. This is how we approach the trading system. This is how we approach the risk. If you adopt and if you own those beliefs about the market, then discipline will no more become an issue for you. You will be very good in following your trading rules. Now, at this point, I'm going to tell you a story. This story will demonstrate to you what is a trading system and how good a trading rule can do for you. Now, I'm presenting you the turtle's story. It is an incident that happened in late 1980s, and the story began with Richard Dennis. And in the left hand side of your screen, you can see a diagram, a picture of Richard Dennis. By the 1980s, Richard Dennis had amassed millions of dollars from his trading operations in grains, and he had become a legendary name. In the 1980s, actually, the commodity market and the grain markets were of particular dominance, not the stock markets. Richard Dennis was a very good trader. He was a trend follower. He used to follow trends. He used to buy successively new weekly and monthly highs in the trending inflationary markets of the 1970s. The 1970s markets was an era of repeated crop failures. When crops fail, not so many crops are produced in the field by the farmers, then naturally crop prices will rise. And he used to buy whenever a new monthly high or a weekly high took place. It was also an era of very high inflation. That means prices of every commodities were rising. So it was a very good trending market, and he took opportunity of those long big uptrends and he made millions of money, millions of dollars in 1970s and in 1980s. In contrast to the vast majority of the floor traders who quickly scalped throughout the trading day, Dennis held positions for longer periods, riding out short-term fluctuations and holding over the intermediate term. He also had a friend. His name was William Eckhart, and he was a person with strong mathematical and statistical skills. So William Eckhart and Richard Dennis were the two persons, and they were doing business in 1970s and 1980s, and they were very successful at their commodity trading business. Today, William Eckhart's firm ETC, which is Eckhart Trading Company, manages funds worth over $1 billion in global financial futures and commodities. Now, what is the story? What did they do in 1980s? Let us check that. Dennis and Eckhart had frequent discussions about their success. Now, although they were friends, they were partners in their business, but their philosophy were a bit different. Dennis believed anyone could be taught to trade the futures markets. Very important thing. Dennis believed anyone could be taught to trade the futures markets, while Eckhart contended that Dennis had some special gift that allowed him to speculate profitably. Some special gift, something that cannot be taught, that is something that a trader is born with. Eckhart also believed that trading cannot be taught, and good traders are just born as good traders. To settle the debate, they decided to carry out a beautiful experiment. What was the experiment? This is the experiment, the turtles experiment, the famous turtles experiment. Dennis would find a group of people to teach his rules to, and then he have them trade with real money. Now, Dennis believed, okay, I trade my own money with some rules, and these rules are objective. These rules completely define me, how to buy, when to buy, how much to buy, and these rules can be taught to anybody. So Dennis would find a group of people and he would teach his trading rules to the students. And then he would give him his own money, real money, to trade them. He took this risk. This is why he became a legendary name. Dennis believed so strongly in his ideas that he would actually give the students his own money to trade. Okay, what happened then? This is what happened then. To the left side of your screen, you can see the ad, the newspaper ad that Dennis put up. It was a Wall Street Journal newspaper, and he put up his ad, and I'm reading out this ad for you. Richard Dennis of C&D Commodities is accepting application for the position of commodity futures trader to expand his established group of traders. Mr. Dennis and his associates will train a small group of applicants in his proprietary trading concepts. Successful candidates will then trade solely for Mr. Dennis. They will not be allowed to trade futures for themselves or others. Traders will be paid a percentage of their trading profits and will be allowed a small draw. Draw means drawdown. That means certain losses that occurs every now and then while trading. Prior experience in trading will be considered, but it is not necessary. Applicants should send a brief resume with one sentence giving their response, giving their reasons for applying to this address. It is a Chicago address, and applications must be received by 1st October 1984, and no telephone calls will be accepted. So this was the newspaper ad that Dennis put in the Wall Street Journal. Thousands applied to learn trading at the feet of widely acknowledged masters in the world of commodity trading. The selection process comprised of a written test and interview, after which 23 applicants were chosen, and they would be called turtles. Turtles means tortoise. Why this name turtles, nobody knows. Maybe Richard Dennis actually visited Singapore a few days prior to that, and there he saw a turtle breeding nursery where turtles were being bred. He had a similar idea. He was also breeding a new set of traders, successful traders. So he thought to give that name. It is not important. No one knows exactly what criteria Dennis looked for in his future students, but they were picked up from across all walks of life. This means whatever be your background, that is not important in trading. All that is important is whether you do carry certain beliefs in trading. You do have attitude to manage risk, to take calculated risk. This is always important for trading. For example, Dennis's students would be comprised from a business school graduate, a former actor, a former trader. That means all walks of life. There is no similarity. There is no pattern. A rehabilitated drug addict and also an illegal US migrant, among others. So your past background doesn't matter. Now, he taught the students his own methods, and he gave them the money, and the process began. And let's see what happens. Did the turtle experiment work? Yes. The turtle experiment was a humongous success, and it became a legend. According to former turtle Russell Sands, as a group, the two classes of turtles Dennis personally trained earned more than $175 million with an initial capital of around $25 million in the 5-year period from 1986 till 1990. I'd like to draw your attention to this period from 1986 to 1990. Those who studied the history of the market would may remember that there was a huge crash in the market in 1987 October. A huge crash. A lot of people lost their money. But following Dennis's system, these turtles were trading the market in that period. And following his system, these people actually made money in that period during that huge crash. Later on, you could see for yourself how Dow behaved in that period. In 1987 October, there was a huge crash. The index fell nearly 30% in 2 or 3 days in October. So they were trading in that period. It was not an easy period from 1986 till 1990, and yet they made a humongous profit. They made a huge profit from $25 million till $175 million in 5 years. Now, Dennis had proved beyond doubt that trading can be taught to beginners successfully. So this is the point to demonstrate. I told you the story. Trading can be taught to beginners successfully. This is good news for us, the students of the markets. If successful trading operations can be broken down into a set of definitive rules, as Dennis proved through his turtle experiment, trading no longer remains an art. Trading becomes a science. This is an important point because many people believe that trading is an art. Well, trading can be approached from an artistic point of view if you have some innate sense where the market is going to reverse, where it is going to rise, where it is going to fall. If you have that sense, no problem. You can approach trading as an art if you have that sense. But it is safe to assume that you do not have that sense. You do not understand what is going to happen next. So for us with people with lesser sixth sense, we will do good if we follow mechanical trading rules, which is called trading systems that we saw here. Trading becomes a science which any of us can follow. All we need is a set of definitive rules called trading system, which is statistically verified for robustness, and the mental attitude. We also need the mental attitude. That was the first requirement. The mental attitude to follow the system through thick and thin. Now, one thing I need to stress here, which is the word robustness. I used a word here, robustness. What do I mean by robustness? A system must be robust. What do I mean by that? Means whatever be your trading time frame, you may trade on a daily or a weekly or an hourly basis on those time frames. But whatever be your time frames, you will definitely want to capture the trends in that time frame. There are trends in all those time frames. But when you are trading in those time frames, there will definitely be frequent pullbacks in those time periods. Say, for example, right now for the past 4 weeks, Nifty is in a pullback mode. So those who are trading Nifty from a monthly perspective, this 4 weeks of fall in Nifty is a pullback phase. So in this pullback phase, as long as his system is defining the present market as a bullish market, so this pullback should not change his trading signal. His system must not reverse from a long to short mode. This is what is meant by robustness. Later on, if market continues to fall, he can change his mode from long to short. But if it continues to be a pullback, then his system should remain in a long mode. Maybe he has exit his long, but should not enter into a short mode. That is, his system must not change his signal just because there is a 2 or 3 weeks of fall on a monthly perspective. So this is what I meant by the word robustness. Every system should be robust. If you are trading on a weekly time frame, then 2 or 3 days of pullback should not be able to change the signal of your system. That is what is called robust system. So our goal is to design a robust trading system. Now, in the latter part of this presentation, I have defined several other characteristics of trading system, but I am not going into details of this. For example, I have defined what is a trading system and why we need them, then subjective versus objective trading system, the science behind mechanical trading systems, why do the conventional indicators and oscillators have no significance outside a trading system. Then I have defined robustness. Then I have told how good is your trading system. This is an evaluation technique. Just because you have a trading system and it is giving you some profit is not enough evidence that you have a good trading system, because this profit may be a result of your good luck. Maybe you have bought, you have sold, and the market was in a very good uptrend and you have bought. So it was your profit maybe was because of good luck. So you really need to test it statistically to prove that whatever success your trading system has had in the past is not a matter of chance. It was because of the merit of your trading system. For that, you need some statistical knowledge. You need to do some statistical testing. These things I'll not be able to touch in this presentation, but I expect to do all these things in some latter part. For now, before I conclude this presentation, I will only show you the first part. What is a trading system and why we need them? A trading system is a precise set of rules that automatically defines the entry and exit point on the markets, along with quantitative strategies for position sizing algorithm. Now, entry and exit points, I think you understand. Now, what do I mean by position sizing algorithm? Let me tell you, position sizing is one of the most important thing in trading. That means just when I will buy or which stock I will buy or where I will exit is not as important as position sizing. I want to be successful in my trading career, not in my 1 or 2 particular trades. That means if right now I am starting with 5 lakhs of capital, I want to get the advantage of compounding. And suppose my trading system gives me a profit of some 30% or 35% over per year. Now, with proper position sizing algo, I can even increase this figure. When I am suffering a losing trade, that my system is giving me losing trades, I will have to reduce my position so that it does not affect my overall capital a huge. But when I am having a good streak, my system is giving me profitable trades, then I need to increase my position size so that I can leverage on my good trades. This is how I can use the advantage of compounding to my capital. So it can be mathematically proved that if you have a good position sizing algorithm and you have a fairly good enough trading strategy, not a superb one. By the term superb one, I am meaning that if someone has a trading strategy which can give them 100% return or 80% return or 150% annualized return. I'm not talking about that. I'm talking about some decent returns, 20% or 30% or 35% return. Now, with proper position sizing algorithm, even if you have some decent trading strategy, you can have the benefit of compounding, so that after 5 years or 8 years or 10 years, your annualized return can be in the region of 80% or 100% or 200 or 150 or 200%, like that. Now, again, this is a function of risk, and every person's risk perception varies. So you have to define your own position sizing algorithm. This is a huge topic. Right now, I cannot touch it, but I'm telling you, if you are interested, you can forward your research in that field. I will give you the direction to do that. Now, your trading system must also have a proper position sizing algorithm. Now, since the rules of the trading system are precise, there is no doubt over when and where to apply them, and this makes the system statistically testable. I told you that to validate a particular trading system, whether it is statistically viable or not, you need to do some tests. For that, you have to precisely define your entry and exit points. The third characteristic is that we should be able to determine how the system have performed in the past and how it would perform in future with reasonable confidence. Now, what do I mean by that? I mean that there is various kinds of markets. A bullish market, a bearish market, a choppy market. This is the directional movements. And along with that, there can be a volatile movement. That means a volatile bullish market, a volatile bearish market. Market rises wildly and then falls wildly. Volatile choppy market. And others are quiet markets, quiet bull market, quiet bearish market. So there are various combinations of these things, and many kinds of markets are possible. Suppose volatile bullish market or volatile bearish market, choppy bearish market, like these things, quite choppy market, like this. So based upon this knowledge, we need to be able to understand whether we shall be able to accept or reject a trading system after we have done our statistical tests in various kinds of markets. We have to take this decision. This is a huge advantage. This is a huge advantage. I'm telling you that before actually risking any single penny, any single paisa on the market, you have the advantage of testing it whether it is acceptable or not. Now, I also stress one thing here, that there is no system that can make money in all market conditions. There are various market conditions, as I told you. There is no such system. The actual survival strategy is to earn more and more money when the system is going through a profitable streak, and when the market is against your system, when your system is giving you losing streaks, your system should be good enough so that you do not lose much money. If that is achieved, then you have a good system. You cannot earn money in every kinds of market, so do not try that. Okay. If you lose less at an adverse market condition, you have got that. So that's it for this particular presentation. I have several more slides to come up. I think you have enjoyed it. Right now I am pausing the presentation a bit, and then I am start to the next slide. Okay, this is the second part of our presentation. Here, the name of this presentation is mental analysis. I hope this is a new name to you. You may have come across technical analysis or fundamental analysis, but take it from me, mental analysis is the most important thing. After this, all kinds of analysis will come. What do I mean by mental analysis? That I told you earlier. The attitude towards risk. How do you define risk? What is your attitude towards risk? These all things will be dealt with in this presentation. Actually, I'm going to deal it with the next presentation, but right now I need to know what is your attitude towards risk. So in this presentation, I'm going to ask you few questions, some 15 questions with mostly yes, no type of answers. I will give you a condition. If you agree to that, you will say yes. If you do not agree to that, you will say no. Now, these questions are designed to bring out your beliefs about the market, your beliefs about the risk, the conception of risk. And these beliefs are defining you at the moment. You are currently trading these beliefs. You are not trading the market, you are trading your beliefs. You can relax. There is nothing right or wrong about these choices that you are going to make here. You just enjoy the process and keep a note of your replies. I think you will enjoy this. You will also get to know yourself, your psychological traits about risks. If time permits, we shall revisit these questions at a later stage. So let me go through these questions, and I am asking for your kind reply. First question: to make money as a trader, you have to know what the market is going to do next. Okay, I'm getting the replies. Someone says yes, someone says no. Okay, thank you. I got my replies. I'm going to the next question. Sometimes I think there must be a way to trade without having to take a loss. Thank you for your replies. I'm going to the next question. Making money as a trader is primarily a function of analysis. Means if you are good at analysis, you can make money. Okay, I got the replies. I'm going to the next question. My risk is always defined before I enter a trade. Okay, thank you. I hope you are enjoying these questions. Next, I would not even bother putting on the next trade if I was not sure that it was going to be a winner. Okay, I got the replies. Thank you. The more a trader learns about the markets and how they behave, the easier it will be for him to execute his trades. Okay, on this question, it seems everybody is agreeing that it is the case, it is the correct case. So everybody is saying yes. Thank you. My methodology tells me exactly under what market conditions to either enter or exit a trade. Methodology means my trading system. Okay, I'm getting the replies. Okay, thank you. I often feel that the markets are against me personally. Okay, I got you, Karan. Karan says, I don't have a methodology though. Okay, I'll get back to you. uh, I often feel that the markets are against me personally, and everybody is saying no. Okay, that's good. Next question. I try, but I still find it very difficult to put past emotional wounds behind me. That means whenever there is a loss, I feel an emotional pain and I cannot leave the pain behind. It always comes. Okay, thank you for your replies. Now I'm going to the next question. A trader's job is to identify patterns in the market's behavior that represents an opportunity, and then to determine the risk of finding out if these patterns will play themselves out as they have in the past. You can take your time to understand the question a bit longer. Okay, I got the replies. Thank you. I'm going to the next slide. Trading successfully requires a degree of mental flexibility far beyond the scope of most people. Far beyond the scope of most people. It is otherwise it is saying trading is very difficult. Okay, I got the replies. Thank you. The most important component in a trader's ability to accumulate money over time is having a belief in his own consistency. Okay, got it. Here I will take some time to define the word consistency. Consistency means not that every time you will be profitable. Consistency means you have a system, and this system is profitable in the long run, not on a trade by trade basis, but after 20 trades, after 30 or 50 trades, your system should have some profit. If this is occurring, then you have a consistent system, and this is what consistency is all about. Okay, I got the answer. So I am going to the next slide. The next slide is not a yes no type of answer. It is just I am asking to write you one sentence here. If you were granted a wish to be able to instantaneously acquire one trading skill, which skill would you choose? One trading skill, anything. You could be asking for, maybe I become a better analyst, maybe I become a better manager of risk, like anything. Okay, Karan says analysis of market trend. Prakash says emotional strength. Okay, emotional strength. Okay, I take note of this. Okay, I got the answers. I'm staying here a bit longer if some more answer is coming, because one has to write sentence. Okay, from Digonto I got the answer, a better trend follower. Okay, a better trend follower. Okay, I'm staying here a bit longer. Okay, got it. Thank you. I'm going to the next slide. I often spend sleepless nights worrying about the markets. Yes, I'm getting the answers. And yeah, everybody is saying no, which is very good. Let me tell you here, if this is the case for you, that you have to spend sleepless nights worrying what is going to happen tomorrow morning, then definitely something is wrong with you, and your system is not up to the mark. Not about your system, it is about your trading psychology, your attitude towards risk, that there is some flaw. So I'm happy that everybody is saying yeah, no. Let me go to the next question, which is the last one. This is another question. I am asking you to write a bit about it. Sentence. In one sentence, please state why most traders either don't make money or are not able to keep what they make. Why people lose? What do you think? Okay, I'm starting to get the replies. Okay, I'm getting more replies. I'm staying here a bit longer. This is the last question anyway. Okay, got it. Karan says inability to predict market trend and not able to take risks at the right time. Yeah, that is the point. Do not know better risk management, said by Diganto. Ravi says don't have proper trading system. Prakash says we are always in a hurry to make quick money in today's fast-paced life. And okay, okay, got it. Thank you for your replies. As I told you earlier, there is no right or wrong about these replies. But I will revisit this section later if I get some time. But before that, let me tell you my acknowledgement. These questions are taken from the questions and concepts are taken from Trading in the Zone by Mark Douglas. This is an excellent book on trading psychology that I am recommending you very strongly. In fact, this is the single most important book that changed my perspective towards risk. Uh, and if you go through it, you will understand how one should approach the market with the proper mindset of risk. And thank you only for this slide. Another slide is going to come here. This is my mail ID. If you have any queries, you can mail to me to this ID. And now I'm pausing it again and going to the next slide. Okay, this is the third presentation of this morning, and here we are going to tell you exactly what should be the proper mental attitude towards risk. I think this will be a mind-opening session for you. It actually changed my perception of risk many years ago when I went through these conceptions. I'm not saying there will be no loss. There will be loss. Loss and profit, this distribution is an eternal distribution in our trader's life. But what should be your attitude towards loss? How should you approach loss? Uh, these things you will understand from this presentation. Right now, I asked you some 15 questions, and I told you that there is nothing right or wrong about those questions, which is not the case. There are actually rights or wrongs about these questions, and if you have the proper mental attitude, you could say what should be the answer to these questions. Now I am going through these section. This is a lesson, and I hope you will enjoy this process. I start with this slide. Trading is simply a pattern recognition game. To the left side of your screen, you will see this is a Fibonacci pattern, which is not the case here. I am not going to teach you Fibonacci. This is just to show you a perspective. Trading is a pattern recognition game. This pattern may come from moving averages. You could say two moving averages crossover, that's a pattern, or there is a head and shoulder formation, that's a pattern, or there is a trend line violation, that's a pattern. So anything could be a pattern, and our job as a trader is only to recognize what pattern is there. We use analysis to identify the patterns, define the risk, and determine when to exit. The trade either works or it does not. Now, even after we do all these things right, there is no guarantee that the trade will give us some profit. Why there is no guarantee? Even if we do all the things right, I will also tell you that. But we all know this, that even after we do all the good things together, the trade may or may not work out. But that does not mean your system is wrong. This is where many beginning traders make the greatest mistake. They generally have a good system. It is not that they do not have a system. They generally have a good system. But whenever a losing streak occurs, 1, 2, or 3 streaks occur, they start to doubt their own trading belief. They start to doubt their own trading system, and they try to tweak it. Let's change the moving average length. Let's make the MACD a bit faster. Let's do this. Let's do that. So this is the mistake that they are causing, and this is why they are jumping from one system to another. Then that system is working for a few days, it is then stopping working, then they are going to another system, then another system, and this cycle is going on and on and on. So you must know that even if you do all the things right, the trade still may either work or it may not work. But you have to keep doing the same thing. In any case, we have to go on to the next trade. Trading should be this simple. This is the only way to trade. There is no complexity, nothing. But this is not the reality. We make it complete, we make it complicated, we make all sorts of mistakes, and we do things like this. Whenever we put on a trade and it starts showing profits or loss, that means real money is coming into our account on an M2M basis, or we are losing money and money is going from our account, an internal conflict begins in our mind. To the right side of the picture, you have shown a diagram of an internal conflict. One is the good spirit and the other is a bad spirit. The good spirit tells us what should be done, what we are, our rational mind, this tells us what should be done. The bad spirit tells us, no, let's act right now, let's savage the moment, let's do this, let's do that for our short-term gain. The moment we put on a trade and it starts showing profits or losses, an internal conflict begins in our mind. How much profit is enough? Should I average on losing positions? All other thoughts occupy us. What happens? Chances are high that under pressure, wrong choices are made. We make up ending wrong choices because we are driven by short-term profits. We are driven by short-term gains, as I got a reply a few minutes ago. Yes, that was the right reply. Maybe a losing position is kept open for too long, or a profitable position is closed too soon. All these things, all these mistakes occur because we do not understand the risk of not following the rules. Now, one thing is for sure, that how the market behaves and all those things is not going to help you. In reality, trading is one of the hardest things you have ever attempted. It is not because it requires intellect, quite the contrary. Now, trading is not a game that is won by the person with the greatest IQ. It is not a game where an IQ of 200 beats a person with IQ of 150. It is not a game like that. It is only a game where if you understand risk, you will earn and you will survive in the longer term. And if you do not understand the risk, you will not survive the game. I'm also saying that trading is the hardest thing you have ever attempted. Uh, because more you think you know, the less successful you will be. What do I mean by more you think you know? I mean, by doing this, you are trying to predict the market. You are trying to know where the market is going to go tomorrow, on Monday, on Tuesday, every day. You are trying to predict what the market is going to do, because that is normal. That is normal case. That is a common mistake, because you see, in every other aspect of life, you have earned profit because of your knowledge. You got marks in your exam because you knew all the answers, right? You cracked a job interview because you knew all the answers. So in every other aspect of life, you got success because you knew something. Now here, trading is different, and it becomes difficult because your knowledge is not going to help you. Because trading is difficult because more you think you know, the less successful you will be. Trading is hard because you have to operate from a state of not having to know. You have to tell yourself that I do not know what is going to happen Monday. I do not know. But if market rises, I know I will do this. And if market falls, I will do this. This much is sufficient. You need not know. But these lessons I'm coming later. So trading is hard because you have to operate from a state of not having to know, even though your analysis may at times come out to be correct. That means you definitely have some analytical process. Your analytical process may be telling you, well, there is a probability, there is a bigger probability that market is going to rise on Monday or market is going to fall on Monday. And your analysis will at times be correct. But that means nothing. Your analysis will only tell you how to create or how to design a trading system. That much. Once your trading system is designed, your only job is to follow your trading system. Nothing else. So trading is hard because you have to operate from a state of not having to know, even though your analysis at times come out to be correct. Go through this slide. I'm giving you a few seconds to go through it. Okay, let me explain this. Trading should be approached from a point of view of a business. We are doing a business. Now there are other several business. There is any other business. You can take any other business. Suppose we are taking a business of the largest retail business, which is McDonald's. Let us take the case of McDonald's. McDonald's have a business model. They open stores, they operate those stores, and they are having a profit from that. McDonald's retail business model or any other business model, here I have shown you the business model of a casino. We have to understand why what is the common trait of any successful business model? Because our trading operation is also a business model. If we can understand this approach, then we can copy these conceptions to our trading strategy. Let's think about a successful business model, the casino industry. Now, in this industry, okay, in India, maybe this operation is not as legal, but in the Western world, in US or in Europe, this is a valid business model, and millions of dollars are spent in infrastructure. You have seen these infrastructures in the cinemas, or anybody have visited there. There is huge money spent in the infrastructure. The gamblers are sometimes given free drinks, and still the casinos are reporting millions of dollars of profit year after years consistently. The casinos are actually run like any corporation. They have board of directors. The board of directors are responsible to the shareholders, and they they are responsible to show profits, and they are showing millions of profits, millions of dollars of profit every year. Now, here is a question that comes to our mind. Suppose there is a game of there is a game of roulette. Okay, the picture to the right, you see it is a roulette game, and it is a random. The outcome is random. The gambler may sometime win, or the house may sometime win. The house wins, the gambler loses, and the vice versa. Now, there is a ball, and the ball can occupy any of the boxes, any of the squares. It is either red or black, and if it is in the red square, the gambler wins. It is in the black square, the house wins, and anything, like that. Now, my question is, nobody knows where the ball will land, in a red square or a black square. Nobody knows. The outcome of a gamble is random. Anybody can win, the gambler can win, or the house can win. So if that is the case, then why the industry is spending so many millions of dollars to set up the casino industry, to set up the casino business? Because there is a perfectly even chance they can win money or they can lose money. So what is the point in setting up the infrastructure? There is no point. In fact, we can ask this question to any successful business model. If we have to run our trading operations like a business, we need to understand why a particular business model succeeds. Only then we can emulate this process into our trading. Here is the answer. Why this kind of business model actually makes money in the long run. Yes, the outcome of any particular game is random. The house can win or the gambler can win. But this is not a 50-50 probability. This is not a 50-50 probability. The house has a very small advantage over the gambler. It is to the extent of 4%. You see, there is a green box also. This green box actually belongs to the house. If the ball lands on this green box, then the house wins. So that gives a very small advantage to the house over the gambler. That means if in terms of probability, the gambler has a 48% probability that he will win, and the house has 52% probability that the house will win. So there is a difference of 4%, only 4%. What does it mean? That means if I take many games of roulette, if the house plays many games of roulette, then over a very long sample size, for every dollar that is played on this game, that is bet on this game of roulette, the house will net win 4 cents, only 4 cents out of $1. But that 4 cents transfers into millions of dollars because the house never stops playing. Now, this is the key strategy, that the house continues the game 24 hours a day, 7 days a week, 52 weeks a year. Every moment there is a game going on, and every moment gamblers are coming to make them come. The house is offering them free drinks, and 5-star stays in their suits and whatnot. Now this 4 cents, that is one in every game. I'm not talking about every game, but I'm talking about a sample size, and this sample size comprised of large wins in favor of the gambler to large losses in favor of the gambler. So anything can happen. The house can lose a lot, the house can win a lot, and every result we can think of in between these sample size. So when we are taking all these sample size, some 100, 200 or 1000 samples, then we will see that after this huge sample size, the house is a net winner because of this 4% added probability, because of this 4% added advantage. And this is the advantage. This is called the edge of the house over the gambler. And this is the edge we are also seeking in our trading. When we are looking for a particular pattern in the market, suppose a moving average crossover or anything else, or RSI falling below 70 or RSI rising above 30, all these technical parameters, when we are looking at these edges, these are edges. These things do not mean that every time they are occurring there will be a profit. That is not the case. But if I do this single particular pattern, if I trade this single particular pattern for 100 times or 500 times, then I will have an edge. Maybe I will be a net winner. But for that, I have to define precisely what will be my entry and exit points. This is the model that is followed by any successful business model. Any successful business model. Right now, I told about the McDonald's model, which is the largest retail business in the world. They also open stores in many areas. They do not know whether any particular store will be profitable or not, but their job is to open stores. Their job is to serve the clients, serve the customers, and they have seen that over a longer period, if they keep on doing this, then some stores will give them profit, some stores will give them loss. But over a huge sample size, over a big sample size, they will be net profit, and they are never stopping this. They are also remaining open for a long period of time. In fact, I have heard that they also operate 24 hours a day in many cities and in many countries. So they are doing their business, and that is the key. They are not stopping. They are repeating their age over and over again, so that the small age plays itself over and over again, and this age is converted into millions of dollars at the end of the year. This is the key to any business model. And this is the key that we have learned from this business model, and we are now going to transfer it into our trading models. Now here, let me go to the next slide. Here, I'm going to give you 5 fundamental truths about the market. Those I told you in the beginning of this presentation. So far, we have defined the problems. Now let us address the solutions. In the following slides, I am presenting 5 fundamental truths about any markets or trading approaches. Please pay close attention. Once you understand these conceptions, you shall attain the proper mental attitude to deal with the uncertainties of the markets. You will understand risk, and you will be able to follow a trading plan with discipline. Here I'm going to give you 5 fundamental truths about the market. Keep close attention, and you can ask me questions if there is any problem, but I will prefer the questions at the end of the session. First, this is number 1. You have to believe that anything can happen to the prices. Anything can happen to the prices or to the market. Why? Because what do I mean by the term anything can happen? By the term anything, I mean prices can either go up or can go down. This is the actual mental attitude that should be that is the friend of any trader. He should never say that I know the market is going to rise. That is the wrong attitude. I know the market will fall tomorrow or Monday. That is the wrong attitude. His analysis may say that. Okay, his analysis may only tell that there is a higher probability that the market can rise. But even if market does not rise, even after his analysis the market does not rise, he should be able to handle that situation from his trading strategy, from his trading system. His trading system should be able to give his give him an situation, give him a situation so that he can handle if something does not happen as per his expectation. So why anything can happen to the prices? Because there are always unknown forces operating in every market at every moment, and it takes only one trader somewhere in the world to negate the positive outcome of your age. Only one trader somewhere in the world. What do I mean by that? Suppose you have a trading system that says if these things occur, I will buy. And that things occurs. Suppose there is a 1330 moving average cross or 50-200 moving average cross. It's a bullish cross. You are buying. Now, if at that point, if an institutional trader believes that he has to sell 1 million shares, okay, he has to sell 1 million shares, then whatever methodology you use, prices will fall down. He is an institutional trader. He has that power to move that market, and we do not know how many institutional traders are there, who is doing what in our market. We do not know. There are always unknown forces. We cannot identify every forces. Something may occur in Brazil, or something may occur in Canada that can affect our market, right? So we cannot take care of that. No process of analysis can take care of that. So we have to believe that even after every point of analysis that we do, the prices still can either rise or fall. Regardless of how much time, effort, and money you have invested in your analysis, from the market's perspective, there is no exception to this truth. There is no exception to this truth. Remember this. If you expect the market to rise or fall because certain things happened, then we can stick to our trading system. How you can how are you exposing yourself to pain? If you expect that market will rise, or if you are dead sure that the market will rise, then you are exposing yourself to potential pain. So always believe that anything can happen to the prices. This was our first fundamental belief. Second, you need not predict the future price direction. Now, in the first presentation, I told you that anything can happen. You cannot predict. Now, in the second part, here, I am telling you that you do not even need to predict the future price direction in order to earn money, because you may be wondering, if I cannot predict the market, how am I going to earn money? So here I am telling you, you really need not predict. There is no point, there is no need to predict the future price direction. How? Suppose, based on past performance of your age, you can reasonably expect that out of the next 20 trades, about 12 will be profitable and remaining 8 would be losing. This is the age that you have developed from your backtesting of your trading system. You have devised a system, you have backtested it over all kinds of market situations, and this is the average result that you have seen. What you do not know still is that what will be the sequence of these winners and losers. That means you do not know what will be the result of your immediately next trade. It could be a profitable trade, it could be a losing trade. You do not know that. The sequence, profit, loss, profit, loss, profit, 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 loss, profit, loss, profit, loss, loss. This sequence, you do not know. What will be the sequence? And you also do not know how much money the market is going to make available on your winning trades. You also do not know how much you are going to win in your winning trades. Now, if you understand this, you will accept that trading is a game of probabilities. You have to accept this. Trading is not a game of prediction. Trading is only a game of probabilities. That means sometimes your age will play itself out, like the age in a casino we saw. Sometimes it will not work. But over a longer period of time, it will be a net winner. If you can know that, then there is no point in knowing what the market is going to do. Is it not that? If you understand this, you will accept that trading is a game of probabilities, where outcomes are random in the short term. Random in the short term means you do not know what will be the distribution of your profit and loss, right? But their average overall aggregate are quite predictable in the long run. But you also know that if you make 100 trades or 200 trades, that after this many trades, you will be net profit. You will be in the net profit in the long run. When you really believe that trading is simply a game of probabilities, it is not a game of predicting the future movement of the market, concepts like right or wrong or win and lose will no longer have the same significance. Right or wrong, you need not be right in the market. There is no point in being right or wrong, right? You only have to follow your rules. Here, I can remember a story. There was a successful trader and he was being interviewed by a reporter who asked him, why are you in the business of trading? He said, his reply was that, I have made many mistakes in my life. I went to the wrong college. I chose a wrong subject for me. My marriage was a disaster. Everything in my life went wrong. That's why I came to trading, because I know that trading is the only business where you can make money even after you are wrong. So this is what he's referring, right? He is referring that you can be wrong in suppose 12 trades or 13 trades out of 20. But the remaining 7 or 8 trades can give you profit, so big profits, that you can be net profitable after those 20 trades. So if you can understand these concepts, this will be the point. Trading will be easier for you. So when you really believe that trading is simply a game of probabilities, it is not a game of predicting the future movement of market, concepts like right or wrong or win and lose will no longer have the same significance. I'm in continuation of the previous point. I'm explaining it here. What will happen if you expect the market to rise or fall, but it goes opposite to your expectation? You will feel pain. Your confidence will take a beating. Your subconscious mind will start to interpret price ticks as threatening. Price ticks as threatening because every tick, suppose you are short in the market, you are expecting prices to fall down. Now every uptick, prices are rising. Every those upticks will give you pain. You will be afraid to follow the market. You will like to come away from the market, but you will also not be able to go away from the market because you are showing a loss, because you are expecting prices to fall and it is going higher. So you will feel the pain. So that is the problem. You will retrace into a negative and defensive state of mind. You will no more enjoy the process. Trading will become very stressful for you. All these things will happen if you expect the market to rise or fall, right? Now, what will happen if you do not expect the market to make your trade right? Say to market that I do not need this trade of mine has to be profitable. Mr. Market, you can do whatever you wish to do. I am right here. I have my stop loss. I will know how much loss I can take. I will exit. But if you do whatever you wish to do, I'm happy with that. This is your proper mental attitude towards the market. If this is your proper mental attitude, then you shall no longer be afraid of being wrong. Market information or ticks, even if you are short and prices are going higher, you know you have a stop loss there. You know this much of loss can occur to me at maximum. So these ticks will no longer be threatening to you, and trading will become a stress-free journey for you. Because you know, if you follow your process and you take 20 or 30 or 50 trades, you will be net profitable in the long run. So there is no need to be profitable in this very trade. No need. So this is how you will become a stress-free trader. This is exactly what I explained here. So I'm just moving it over very quickly. Before you put on a trade, all you need to know is that the odds are in your favor because there is a signal for you. The odds are in your favor, right? You just know that if you follow this particular kind of signal, then you will be net profitable in the long run. and there is again this signal, so you will take this signal. You know your risk or stop loss. That's the cost of opportunity. What is stop loss? Stop loss is nothing but the cost of opportunity. You have this opportunity. You have a trading system. Your trading system has shown you there is an edge. You have to buy there. If you have to buy there, if this is an opportunity, there is also a stop loss. And that is the cost of this opportunity. If this edge does not play out, you will have to pay this cost. That is the stop loss. That you also need to know that your age may or may not work out this time, resulting in either a profit or loss for this trade. But in the long run, your age will work out definitely. If you know this, and also you know that nobody knows what is going to happen immediately after you put on a trade. But who cares? Nobody knows. Even the market itself does not know where it is going to go, right? If it knew it is going to go higher, then it would have gone exactly now, immediately now. Why it would go later? Right? So nobody knows, including the market. We only have to know, we only have to do what our system tells us to do. Now, if you believe in these principles from the core of your heart, then one losing trade or even a series of losses cannot hurt you. If your age puts the odds in your favor, then every loss takes you closer to the next winning trade. After that, your attitude to a losing trade will no longer take on a negative emotional response, and you will be more likely to stick to your game plan stronger than ever. This is how discipline can be achieved. If you believe in these principles, others will say that, oh, how disciplined you are. Others will start envy you because they are not being able to follow their own discipline. But you know that if you follow these principles, then following your own discipline, following your own trading rules will not be difficult at all. This is the recipe for successful speculation. This is the recipe for any successful business venture. Do not, the 5 principles that I am going to tell you here do not apply only for trading. They apply to any business venture. And when I'm going through this, you can take it for yourself. This is the third principle. The third fundamental way how the markets behave, the 5 fundamental truths about the markets. I'm saying here that there is a random distribution between profits and losses for any variable that defines an age. I'm giving you a few seconds to go through this slide, then I'm explaining this. Okay. I'm reading it out again. There is a random distribution between profits and losses for any variable that defines an age. Let me explain this with an example. I'm coming back to that slide again. What you see here is a snapshot of my own trading strategy. I trade this strategy in crude oil. This is a result summary, a snapshot. I have many trades, and this is a result summary of these snapshots. You do not have to understand all these columns, all these entries, but I will draw your attention to one particular column, the F column, where in red or green you can see the whether a particular trade is in profit or in loss, whether I have taken a profit or I have taken a loss. You can see the first 4 trades were losses, then the following 3 were profitable, then loss, profit, and this sequence goes on. Now, what this third principle tells us is that I'm going to it again. There is a random distribution between profits and losses for any variable that defines an age. Now, why I am buying here or why I am selling here? This is a variable that I have defined for myself. These variables give me some buy signals, some sell signals. I am taking those signals, and accordingly, I am getting some trades profitable, some losing trades. Now look at this distribution in F column, profit loss distribution. These distributions are absolutely random. Absolutely random. There is no pattern at all, right? There is no pattern. I do not know whether my 7th trade will be profitable or losing, whether my 13th trade will be profitable or losing, and nobody knows. Nobody knows that. So, and you can also see sometimes I have a bigger losing streak. I have 4 losing trades, then I have 5 losing trades, and so many things. Right now, here I have more losing trades than I am winning trades. But that is a separate story. But if you can if you look at my losing number of boxes, the boxes are the unit by which I count my profits or losses. Then my average losses are lower than my average profit. Then come back to H column. My starting equity was 403, and my ending equity, that is the last row of the Excel, my ending equity was 528. Now, what is the unit? They are not rupees, they are boxes, but that is a separate issue. 528 of anything. Although, what I need to show you is that although my system has bigger number of losing trades, but because my average losses are lower than my average profit, I'm making more when I am in a profitable trade. So that's why I am being in a net profitable situation. So here are some 25 or so many trades. So of which I have had some 5 or 4 losing trades. Now this is also a lesson that people become impatient. People become impatient after 2 or 3 losing streaks, and they change their system, right? But if you have a proper backtested system, if you know how much loss your system has previously suffered, then you know even a bigger losing streak may come. But you have to pass that on. You have to take all those trades. You cannot stop there because I have had so many losing trades, let's stop it there. You cannot say that, right? You have to follow the process. It is only after you have taken so many number of trades that the positive expectancy of the system keeps coming. Positive expectancy of the system. I know my system has some positive expectancy that if I go on taking so many number of trades, I'll be net profitable in the long run. So this is what is meant by that. So the point I want to make is here that there is a random distribution between profits and losses. Nobody can tell you what the next trade is going to be, whether it is profitable or losing. Nobody can tell you. It is a perfectly random distribution, right? And you have to follow this process. Just remember what we told about our casino business. Even the casino did not know which gambler is going to take money from them and which gambler is going to give money to them. They do not know, but they are welcoming all the gamblers, right? They are encouraging all the gamblers to take their game, and they are encouraging them. They are taking trades like this, and after a huge sample, they are earning money in the same manner. So I'm going back to the previous section where this is the third principle. There is a random distribution between profits and losses for any variable that defines an age. What is the right approach? The right approach is that you have to think that every losing trade takes you closer to the next winning trade. If you know this, you will then look forward to the next occurrence of your age with a very positive attitude. Just because a trade was losing does not mean you have to stop the system. If you have your proper backtest result and you know that there was a sequence of 8, 9, or even 10 losing trades, it has occurred to me. I have had 10 losing trades in a row in gold, right? But even that system was a profitable system, and all those losses was recovered in my 13th or 14th by the time I reached my 13th or 14th trade. But after I have gone after I have gone through so many losing trades, some 8, 9 or 10 losing trades, I must take the 11th trade as well. I must take the 12th trade as well. That is the proper mental attitude, right? Now, if you are now ready and waiting to jump in without the slightest hesitation or reservation when your age shows up again. So whenever your age shows up again, you have to take that signal. This is the right mental attitude. What is the wrong mental attitude? If you still believe that trading is all about analysis and being right about directions, then that is the wrong attitude. In this case, then after a loss, your morale will be down. Why? Because you know that you have predicted the market in the wrong direction. So you will think that there must be some mistake in my analysis. There must be some mistake in my indicators around those things, and you will again start the process from the beginning, and you will then move on through the same wheel again. Because you was wrong in your previous guess, you will feel the pain. This will put pressure on you and make your trading life very difficult. So this is the approach you have to avoid. This is what I have defined as an age. Now in my third principle, it is the third principle, there is a term called age. There is a random distribution between profits and losses for any variable that defines an age. Now what is age? The fourth principle defines age. Age is simply a higher probability of happening one thing over another, right? Age is simply a probability, nothing. It is a higher probability of that this thing will happen and this will not happen. Trading is not about hoping, guessing, or gathering evidence outside your trading systems. That means if your trading system is comprised of these 3 indicators or these 4 indicators, then you will not go outside your trading system of these 3 indicators and take another 4th or another 5th indicator opinion to decide what the market is going to do. That's the wrong approach. It will destroy your age. So trading is not about hoping, guessing, or gathering evidence about whether your next trade is going to work out. The only evidence you need to gather is whether the variables you use to define your age are present. If your trading system signals you a buy, you will buy. If your trading system signals you to sell, you will sell. That's the only thing you have to decide. If you use random variables outside your analysis that I told you, that if you have 3 indicators and you are still afraid to take that trade when those indicators are giving you a buy signal, and you are taking opinion from another indicator, then you are doing it all the wrong way. It is akin to guessing whether the next flip of a coin is going to be head or tail. You are coining a toss, tossing a coin, and you are trying to guess whether it is going to be head or tail. There is no indicator that can predict that, but you are just trying to do that if you take the help of another indicator outside your trading system. Nobody knows that. If you have to be confident about the long-term positive expectancy of your system. Your backtest will give that confidence, and only then you will be able to handle the short-term random outcomes. Else you will experience fear. Here are two points are important here. The short-term randomness. In the short term, there will be randomness. See, look at the trades distribution, profit loss distribution. In the short term, there is absolute randomness. Nobody can tell whether a particular trade will be profitable or losing. Nobody. But in the long run, there is a positive expectancy of the system. That means after a 20 or 30 or 50 trades, the system will be profitable in the long run. That is predictable. That is not random. That has a big probability. That has the higher probability. So you also have to believe in the positive expectancy in the long run. So 2 things you have to believe. In the short term, it will be random, and in the long term, it is profitable. If you can believe in these 2 things, then you are true. Else you will experience a fear to take every trade, right? Which is not the proper mental attitude. And this is the 5th and final point, which is saying that every moment in the market is unique. What do I mean by that? Every moment in the market is unique. It means that suppose you have a trading signal. Suppose there was a moving average crossover, which was what signal. You bought it earlier. Suppose in your previous trade, it was a losing trade, right? You bought upon your age and it gave you a loss. Now, this crossover is occurring again. And you were thinking, oh, last time there was a loss. So maybe this time it can also be a losing trade. So let us not take that trade. Okay? So this is the wrong mental attitude. You have to understand that this particular signal that is occurring now has nothing to do with the signal that occurred past. That loss has nothing to do with this signal. Now, but our mind actually plays a trick here. Our minds are programmed to subconsciously associate anything in the external world that is similar to anything inside us in the form of memory. We carry memory. We carry bad memories. We carry good memories. And these memories are working against us at this moment. These memories are telling us that, oh, do not take this trade because last time the same signal gave you a loss. This belief or attitude is causing us harm. This creates an inherent contradiction between the way we naturally think and the way the world exists. No two moments are similar because if it were so, every atom, every molecule would be in exact the same position they were in some previous moment. Is it very likely? No. Now, what do I mean by that? Take the example, take the previous example. Suppose you took a signal of your system and it was a loss. Now, maybe it was a loss because of some trader did not believe in your opinion. You bought there, but some traders sold there. And so they sold it so heavily that prices fell. So those traders sold there. Now, again, your signal is playing it out here. Now, there is no guarantee. In fact, there is no probability that those very same trader will again come here and do the same thing. It is not likely. If you take so many trades, if you take a 50 or 100 sample trades, then it is very unlikely, or it will almost never happen, that the same set of traders, every trader, every molecule, every atom that happened to be as it was in your previous losing trade is occurring here again. So that is a very unlikely probability. If you believe that, then you will understand that no two moments are similar. So there is nothing that is stopping you to take you the current trade as well, just because it was losing in your previous trade. Our minds are designed to process information in such a manner that we could perceive the now moment to something similar to a previous moment as it exists inside our minds. This is what is meant by memory. The now moment means something that is occurring now. Now, our mind are associating the present occurrence of our trading signal to associate with something that occurred in the past. So, our minds are causing us not to take this trade, which is the wrong thing to do. So, you have to believe that every moment in the market is unique. How does this concept help us? This is what I told you. If each moment is like no other, then there is nothing at the level of your rational experience that can tell you for sure that you know what will happen next. So again, I go back to my first belief that you cannot predict what the market is going to do. And this is the reason that you cannot predict, because every two moments are different. If you believe that you correctly predicted the market once, you will naturally try to do it again, right? As a result, your mind will automatically scan the market for the same pattern, circumstances, or situation that existed the last time you correctly predicted the market. This is the problem of prediction. You know, you predicted it once, right? The market went in the same direction as you predicted. Now you felt very happy, you felt elated because your analysis was right. Now naturally you will try to do it again, and I'm not telling you cannot do it again, right? You can do it, no problem, you can do it, but this is a very risky way of doing business. This is not the way businesses are done, right? Because by exposing you to the movement, to the prediction, you are exposing you to possible pain. If the market does not move in your direction, then you will feel the pain, right? And this will harm you. This will stop you to take the trade. So do not expect that market will move according to your prediction. You only have to take the trades that your system generates. That's all. I'm not implying here that you cannot predict the market. Most certainly you can. But it is in the time to predict that you are setting yourself up for a disappointment. Because from the market's perspective, the previous situation where you predicted it right and the present situation where you are seeing a similar pattern to recur are not similar at all. That is what I told you. So this is the fifth belief, that no two moments are similar. Every moment in the market is unique. You have to believe this. You have to understand this. Only then you will stick to your discipline. More application. Suppose we trade a particular pattern. I told you earlier, whenever this pattern appears, we take the trade. Does it mean that the outcomes will be similar in every case? No. Why no? Because every moment is unique. This is the application. There are innumerable forces acting in the market at any given point, and it takes only one trader somewhere in the world to negate our edge in any given situation. As I told you, there is a positive expectancy occurring, there is a buy signal or sell signal occurring according to your system. You take that, and there is a big trader on the other side of the world, maybe, and he is doing a trade opposite to you. Say maybe he is selling some 1 million shares, right? And it triggers your stop loss. So you cannot predict that, right? Our age has a positive expectancy only over a large sample size. Your age will play itself out only if you take a long number of trades, a large number of trades. In the short term, on a trade by trade basis, results will be random, and we cannot predict whether a trade will be profitable or losing. It also means if the previous trade lost money, or even if each of the previous 5 or 10 trades lost money, we still do not know what is the outcome of the next trade going to be. Based on the past performance of our age, we should always be ready to take on the next plunge. We cannot tell which trade is going to be profitable or which trade is going to be losing. We cannot trade that. We cannot tell that. We just have to take the trade. That is the professional attitude. Now, here is the bibliography. Most of the concepts presented here are taken with gratitude from the excellent book. I mentioned this book earlier, Trading in the Zone by Mark Douglas. There are several other psychology books, but this is the best as I have seen. I strongly recommend you this book. Now, here is one challenge for you. We have come to the concluding part of this presentation, and here are the challenges. I'm telling you this, and take it very seriously. Whatever I told you in this presentation, if you have understood this and if you apply this in your trading, that means if you can devise a proper trading strategy, backtest it scientifically with all the statistical measures that I could not teach you right now, but maybe I will take it up in a later presentation. You are just 20 trades away from success with your own trading system. You do not have to take anybody other's trading system. You can define your trading system, you can design, you can take those trades, and you are just 20 trades away from success. Why I am telling this? Because with this belief, with this knowledge, you will have whatever I told you. You will have the mental strength to go forward. You have to go forward with these 20 trades by the same rules that you have created yourself. Do these 20 trades. If after these 20 trades there is profits or there is loss, then what can be done? That I am telling you. But follow this process. Design your own trading rules, write them in a paper, then take those trades, enter your trades like I entered on this date, on this price, I exit on this trade, on this price, and this was a net profitable trade or a net losing trade. I lost money this much or I made money this much. Do this for these 20 trades according to your own system, and you will see it is not difficult at all. In case you still feel any problem with this, you can contact me with this mail ID. I will be very happy to reply you with your queries. But you have to give me the result of your trade summary in an Excel sheet that I showed you, that my Excel sheet as well. That was only a snapshot. You can do it in your own way. There are other various ways to record trades, but I need this trading summary of yours to help you out regarding this. So remember this, you are only just 20 trades away from success. So do this process, design your trading strategy, enter your trades, keep a record, and you will see it is not very difficult. So with this, we come to the concluding part of this presentation. I hope you have enjoyed it. In case you have any queries or problems, I am right now asking for your questions, if there is at all. You can ask me questions now. The system that I showed you in my trading uh, is not conventional candlesticks. These are point and figure charts, which is not the most important thing here. uh, we hope to carry on. We hope to carry on continuation to this uh, webinar, and we will come up with systems. We will also suggest you. We will also suggest you many trading strategies uh, in some webinars, maybe next to next Saturday. And in those classes, we hope we will be taking about this. We'll be taking up this trading strategies. We will tell you exactly how to design trading systems, how to test them, and in those seminars, I'll be talking about box size as well. Okay, if every moment is unique, then how does certain theories like Elliott wave theory works? Are they viable? Yes, this is a very logical question. In fact, one can ask that if every moment is unique, then how the entire technical analysis is legitimate? Because the philosophy behind technical analysis is that past things, whatever has happened in the past, will these things will occur again in future, right? So you can ask it about Elliott wave, you can ask it about Fibonacci things, moving average, whatever. But the point is that these Elliott wave or Gann theory or Fibonacci, all those things, they are not saying that the market will rise or fall when these signals are coming, right? They are not saying that. They should be viewed as viable edge, right? Every time these edges do not work out. But if the problem with Elliott wave is that it is very difficult to program. It is very subjective method, right? So many things you have to define. Those things are not defined in Elliott wave. But I'm not assuming it a wrong theory. Let's assume it's a right theory. If you can define it, if you can objectively create trading strategies from Elliott wave theories, then still Elliott wave theory will not 100% can tell us that market will rise here with 100% probability or market will fall here with 100% probability, right? It will only give us an edge. If we take some 50 or 60 or 80 trades from Elliott wave, defining our risk, then again, as I told you, that most of the time we will be profitable and we will be in net profit after so many trades we take from Elliott wave theory. Or this is the very basic principle for any technical analysis indicator or oscillator like that. No indicator, no oscillator can tell us exactly what is going to happen every time, right? It will only give you an edge. You have to follow the edge over and over again so that it gives you profit after so many approaches, after so many sample sizes. This is how. What else we will provide in coming weeks? In the coming weeks, we are going to provide you trading strategies, trading systems for stocks in commodities. These strategies, these systems, you can take from us, or you can modify it. But whatever you do, you have to do your own analysis. You have to backtest it, and then only you will be able to follow your trading system. You have to believe in the 5 fundamental principles that I told you, and then it will be much more easier for you to face the market in the long run. In Proficient, I hope you have enjoyed this presentation. In Proficient, we are very eager to promote knowledge through sharing, and this is our motto. If you have any queries, you are free to ask us through the mail ID that I had provided you. Yes, this webinar recording will be available on our site and on YouTube as well, with some modifications or with some edited versions. How many more sessions are on the card? 1 or maximum 2 sessions are on the card. These are free webinars. As you can understand, we cannot go in like this forever. Not every week, every alternate week, every alternate Saturdays. Are we gonna have any informations on investments? What kind of investments? The no, I'm sorry. In this presentation, we are not going to have any discussion on mutual funds. The best thing I can tell you is that stock markets have a bullish tendency over a longer period of time. Stocks do have some bullish tendencies. So if you are investing and then stay invested for the longer period, you have to ride out the pullbacks. Then you can beat the index like that. So with this, we come to the conclusion of this presentation. I hope you have enjoyed it. My email ID is with you. If there is any problem, you can come back to me anytime. Thank you very much.